Chris, I've got a few questions for you. What exactly is a loan officer?
Well, in general, a loan officer is a licensed individual representing a lending institution that evaluates, authorizes, and assists a client through the process of acquiring their loan. The title loan officer is actually rather generic, as there are many different types of loan officers in the various fields of consumer lending. These include automotive loans, home loans, commercial loans, lines of credit, and even business and consumer debt consolidation loan officers. All of these individuals serve as a medium to represent clients in obtaining the proper financing for their situation.
When a loan officer is helping you out, what do they actually do?
In our specific industry, home loans, we are officially titled Mortgage Loan Originators, or commonly just MLO for short. In theory, an MLO guides a client through the mortgage process, helps understand and structure loan terms, and coordinates fulfillment of the funding. However, the reality is really much more. Most MLOs function in more of a sales role than a fulfillment role. Lenders typically provide support staff that handles much of the tasks and processes involved in actually funding and fulfilling the loan. In the sales part of the role, though, MLOs develop a book of business, most often by establishing referral partners and establishing a community presence. And this is in addition to being responsible for speaking to clients to learn about their unique scenarios, which kind of mortgage is right for them, and the process they need to go about to achieve home ownership. The originator, me, then also communicates with home loan underwriters, vendors, third parties, investors, title companies, even government agencies, all to coordinate the secure funding of a home loan. We also work as a primary point of contact for real estate agents and individuals for the status of the loans, as well as educating them on what loan programs are available and what guidelines there are for each.
Chris, I know there's a lot of legal elements to mortgages and lending. Is a mortgage loan officer a licensed position?
Yes, it is a licensed position. The mortgage licensing is overseen by the National Multi-State Licensing System, generally called the NMLS. The NMLS issues licenses to prospective MLOs who meet their requirements set forth. MLOs are required to do the following before obtaining their license. 1, show financial responsibility by agreeing to allow the state agencies to review our credit reports every year. 2, we have to complete at a minimum 20 hours of pre-licensing education. And these courses have to be accredited by the NMLS. It's not just a casual education. And then many states on top also have their own licensing and education requirements. Once you have these done, you have to score at least 75% correct answers on the NMLS's written test. And some states also require background checks and fingerprints as well. And then finally, after your license, you have to maintain an accurate and thorough personal history, address, contact info, and various other information with the NMLS so they have up-to-date information at all times. It's a very compliance-burdened process, but this keeps it safe for consumers.
Chris, with so many different business structures, how do loan officers get paid?
So originators typically have one of two pay structures, salary or commission. A salaried loan originator typically gets a fairly attractive salary and has to hit monthly quotas on various statistics for the company, such as the number of applications completed, pre-approvals issued, loans approved, and many more from my personal past experience as a salaried mortgage loan originator. Now, salaried MLOs will often still have bonus or commission income, just to a lesser extent than full commission folks. A commission originator gets paid per loan based on the size of loans he or she may be closing. These structures can be very simple, such as that MLO gets a set percentage of the total amount of money they fund, or some are tiered, which is more complicated, but essentially they get paid less for the first few loans and get a higher percentage as they increase volume. In the market, you'll notice that some lenders are more expensive than average as they charge a percent-based origination fee too, and that goes directly to the originator and his team, while others get paid off of charging flat fees and selling loans. We charge flat fees. Either way, this money comes from the interest paid by consumers as they make their mortgage payments. We don't get tiny little payments every month. Instead, we're paying full after the loan closes. The company / lender / bank ultimately just pays us this lump sum. And then as they make the money from the interest payments, it's covered and they recoup what they pay us in that manner. So we don't charge typically a fee to the consumer that pays our paycheck. It comes out of the interest that is actually accrued as you pay your mortgage back. So it's not like a real estate agent or insurance or something like that to where there's a fee that just goes into my pocket. Those are great questions.